Kansas City, home sales are picking up even as job growth levels drop off, and that combination has triggered apartment fundamentals to cool off faster than expected. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Kansas City update. The headwinds are picking up in Kansas City. Most discouragingly, the local economy was starting to look really good through the middle of 2012, but job growth has really dropped off since then. Only 4,900 jobs added annually as of Q1 13. That compares to growth of 21,400 jobs back in Q3 of 2012. So we'll see over the next few quarters if this was a blip or a sign of a weak economy, but clearly we're already seeing the effects of weaker job growth. At the same time, though, home sale volumes are climbing. The local realtors report that home sale volumes in the 12 months ending in first quarter jumped 13.4% annually. Prices are up too as inventory levels drop off. So with job growth slowing, Kansas City is having a hard time backfilling these apartments that are being vacated for home purchase. Demand was actually negative in 2 of the past 3 quarters, so occupancy has fallen 50 basis points since Q2 of last year, down to 93.8%. Rent growth levels have dropped off too. Rents up just 2.4% annually as of Q1. By comparison, rent growth had measured 3 to 4% in 6 of the 7 previous quarters. Now, one reason to think home sales are playing a big role is that the most significant cooling is coming at the top end of the market, the units built since 2000. And since new apartment supply is still pretty sparse, it's pretty apparent that the issues do trace to home sales. And drilling it down further, the issue has been most apparent in the higher-end Johnson County submarkets, where home sales have traditionally been a big draw. So let's look at these numbers in the 2,000 plus segment in the combined Johnson County submarkets. Occupancy has plunged 220 basis points over the last 3 quarters, down to 94.2%. And annual rent growth levels over that period have dropped from 7.4%, a big number, to just 1.2%. Now, we have 4 different Johnson County submarkets, so these numbers reflect the weighted averages for those areas. Now, the good news for Kansas City is that apartment construction remains a pretty insignificant factor, and that should remain the case over the next year. So it's really all about the local economy. If jobs start to pick up again, we should see apartments be able to backfill units vacated for purchase a little more quickly. Our expectation, though, is for job growth to pick up only moderately, so occupancy is expected to tick up just a bit and actually remain below 94%, and we're expecting rent growth to remain under the 3% mark. And that wraps us up for KC, so until next time for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.